Private sector lender IndusInd Bank yesterday reported a 50% year-on-year increase in its Q2 standalone net profit due to higher net interest income as well as other income. Let's do a three-point analysis to understand the earnings fine print and also what brokerage houses recommend on the stock. 1. What are the key highlights of the earnings of Q2 FY20 for IndusInd Bank? Well, standalone net profit for IndusInd Bank stood at 1383 crores, up 50% year-on-year. However, the profit slipped on a sequential basis. Now, net interest income rose 32% to over 2900 crore rupees. Also, other income surged about 31% to 1700 crore rupees. Now, lower tax from the quarter ago also boosted the profit this time, while tax expenses fell about 34% from a quarter ago. Now, provisions surged about 25% and also asset quality weakened for the quarter. 2. What has the management said on bank's exposure to stressed accounts now? Well, IndusInd Bank has been at the receiving end of speculations that it is exposed to financially wobbly business houses such as India Bulls Housing, also Z Telefilms, and as well as Diwan Housing Finance, etc. Now, it has lost about a fifth of its market value during successive dips in the stock markets as well. Now, the lender has said that it has a combined exposure to the three debt-laden companies, that is Z, DHFL and Anil Ambani-led Reliance Group, to of about 2100 crore rupees, or only 1.1% of the entire loan book. Now, IndusInd Bank's Chief Executive Officer Ramesh Sopti has also indicated that the bank will further bring down the exposure to 0.8% through stake sale in the ADAG-led Reliance Group. 3. What are the brokerage houses' views then on the stock now? Well, most brokerage firms have slashed target prices on the stock. Morgan Stanley has maintained its overweight rating on the stock, and they have slashed the target price to 1700 from 2000 rupees earlier. Now, Jefferies too has maintained its whole rating on the stock but has slashed the target price to 1405 from 1480 earlier, indicating that the balance sheet is showing clear signs of deterioration on the systemic liquidity issues. The risk reward also is better but not enough to merit an upgrade right now. And CLSA has also maintained its buy rating on the stock but has slashed the target price to 1950 rupees per share from about 2160 rupees earlier.